Good morning. This is Connor from 0DTE Traders here to present the week ahead for October 20th, 2025. In this video, we'll cover the S&P 500, GEX, key levels, and volatility. But before we dive in, big shout out to our team. Excellent performance last week, 85% green, 15% no trades, 0% red, which is the most important thing. It was most certainly a challenging environment, a lot of volatility. So hats off to everyone who came out ahead. Now, if you struggled, or you're ready to take your 0DTE trading to the next level, consider joining the team at 0DTEtraders.com. Link is in the description. Now, with that out of the way, let's proceed with our regular programming. To start the week, GEX, which measures dealer gamma exposure, is positive, 20 million notional, although much more neutral than imbalanced. Trading in close proximity to our main transitional level, 6680 flip. Above, all strikes are positive, that is supportive for the market price. Below, all strikes are negative, that is destabilizing for the market price. However, there are a couple other transitional levels we're looking at that will really tilt control to one side or the other. 6,700 on the upside, bulls will start to gain more of an edge. Above 6,750 is where bulls will have firm control and is where that gamma index will become materially positive once again. As far as the downside goes, below 6,680, we would anticipate more volatility. And then below 6,600, bears will gain firm control. In regards to the trend, if we go to the SPX daily chart, there is some structural damage after breaking this upsloping trend line connecting the May low. However, bulls have successfully defended the most recent low at 65.69, so there's no confirmation of a trend change at this time. If we look at the weekly chart, it was an inside week. This is a sign of consolidation, trading between the previous week's high and low. Two levels we want to keep a close eye on, 67.64. A break would imply resumption of this long-term trend, whereas a break below 65.50 would imply downside continuation and confirm that trend change. Last week, we had option expiration where around 30% of open interest was removed, most notably at the 6,700 strike. Now, these were the positions that came off on Friday, and just think about how sensitive they were throughout the week. Take, for example, a 6,700 call. You move down 100 points, that call is near worthless. You move up 100 points, that call has gained substantial value relative to where it was trading. This requires very active hedging from a dealer's perspective, and they're going to be doing so by chasing price. So they're going to chase deltas on the upside, chase deltas on the downside, which exacerbated the price movement last week. With the removal of these positions, dealers are still likely going to be chasing deltas, however, to a lesser extent. What we really want to be paying attention to this week is what type of new positioning comes into markets. So I would brace for some more volatility here this week, but we tend to see more directional type price movement post-option expiration. This is the SPX daily chart going back to the start of the year, with each vertical line marking the monthly option expiration. And historically, OPEX has been associated with turning points in the market. Take, for example, February, the start of a big down move. March, start of a big down move. April, the start of a big up move. And then, June, for example, you had some weakness to start. And then a decent recovery, ultimately closing flat in that OPEX cycle. I think the point is here, there is potential for perhaps a new directional move start to form this week. Could be up, could be down. I would say keep a close eye on those transitional levels. Transitioning over to sectors, the primary theme over the past month has been that of rotation from growth into defensives, suggesting that participants have been reducing risk and moving into lower beta segments of the market. Utilities and healthcare, both defensive sectors, were the best performers over the past 21 trading sessions. This does indicate a slightly negative tone. Now, growth sectors, XLK, XLY, XLC, account for 55% of the S&P 500, while AI-related stocks make up 45%. So if we continue to see rotation out of these areas of the market, it could drag the S&P 500 lower or at minimum cap upside. So on an intraday basis, we want to pay very close attention to growth, meg stocks. Now, we generally always want to, right? Because they exert the greatest influence. So they often dictate direction. But if we start to see continuous underperformance, it would be an indication that rotation is continuing. In regards to volatility, the VIX remains quite elevated, trading around the 20 level ahead of Wednesday's option expiration. This is the open interest for that OPEX. We got calls on top, puts on the bottom. And the most significant strike is 19. That is what's referred to as max pain. Max pain is a price level where the greatest number of calls and put options expire worthless, essentially causing the maximum loss for option buyers and the maximum profit for option sellers. Prices often gravitate towards this level near expiration due to the option related hedging and dealer dynamics. That's at least the theory. I don't necessarily subscribe to this concept for equity indices, but it has proven effective for VIX expiration. So I would keep a close eye on that 19 handle. As far as this week goes, options are still pricing in high volatility, a bit of a downtick from the previous week. We got 1 day implied move at 0.8%. That is 53 points today, Monday. And then the 5 day implied move at 2.2%. That is an implied low of 65.17, an implied high of 68.11. Now, what's going on this week? Well, the US government remains in full shutdown, which has limited economic data releases. But participants will finally receive September's consumer inflation report this week, following last week's delay. This is due out at the end of the week on Friday. Third quarter earnings season is gaining momentum. Streaming giant Netflix is set to report results on Tuesday, and electrical vehicle maker Tesla on Wednesday. Also on the calendar are major names such as Coca-Cola, General Motors, and 3M. Participants will also be watching US China trade developments closely as tensions persist over China's strict rare earth export controls. Additionally, credit risk has risen among regional banks. Though current issues appear more idiosyncratic than systemic, bank stocks are likely to attract attention this week. And if we go back up to that table of market cap weightings, financials are a very important sector, making up nearly 13% of the S&P 500. So could be a major driver of direction this week as well. Keep in mind, guys, as traders, as risk managers, our job is not to predict the market, but to identify when market conditions change, determine the major variables driving price action, and adapt accordingly.